Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. I'm Campbell Wallace, a senior financial advisor that works closely with Stuart Weems, and I'll be filling in for Stuart again today for the last time whilst he enjoys a break. What I'd like to talk to you about today is surplus cash flow. So just to define what that means, you probably hear Stuart talk about surplus cash flow quite a bit. Really, it's the rate of savings. So how much money you're saving. So after the income from personal work, exertion, and then investment income, and then after all of your expenses, general living expenses, tax, everything else, financial commitments, property expenses, everything that you've got, it's really what's left over afterwards. So that's surplus cash flow. So in the current cost of living crisis and high interest rate environment, many people are finding that they've got a lot less surplus cash flow than they did a couple of years ago. That's very common. But look, a lot of people still do have a good surplus cash flow. And if you do, you've then got a choice to make. And the decision around what you should do with your surplus cash flow is a very common question that we get from our clients. And it's one that I want to dive into today. And I think the most common dilemma, very simply, the two options are between paying down debt versus investing. Now, when it comes to paying down debt, there's obviously two types of debt. To break them apart quite easily, there is non-deductible debt and there's deductible debt. So most people's retirement goals involve owning a home outright. So ensuring their home loan's paid off by retirement is a very common retirement goal that we see, and we completely agree with this notion. We think it's particularly important because it's non-deductible debt and it's secured against a personal asset, your home, which is not income producing. So ideally, you don't want to be carrying non-deductible debt, a mortgage, into retirement and have to carry that expense throughout retirement. So then once your mortgage is paid off, or there's a plan in place for it to be repaid off before retirement, the focus then shifts to investment debt, which is tax deductible and it's secured against an asset which is income producing, typically an investment property, could be a share portfolio as well. So look, paying down investment debt is okay. I'm not here to tell you that it's not a good thing, but I just think with your surplus cash flow, if there's potentially a better return on investment that you can get than paying down investment debt, then I think that that's a better allocation of your cash flow. So on an after-tax basis, paying down investment debt doesn't usually represent a great return on investment, and it's arguably not as good a return as investing the surplus cash flow in other growth assets, for example, shares. So what I mean by this is if we consider an example where an investment loan has an interest rate of 6.5%, which is fully tax deductible, that interest, to someone in the top tax bracket who's paying 47% tax, the after-tax interest rate, once the tax is deducted from it, is actually 3.45%. So that's the after-tax investment return, or the return on investment that you're going to get from your money by paying down deductible debt. Therefore, I think the question is, well, if you were to invest your surplus cash flow in growth assets such as shares, inside or outside super, or other types of growth assets, would you be likely to receive an after-tax investment return greater than 3.45%? And I think the resounding evidence suggests yes. Historical evidence suggests yes. So as a benchmark, let's look at the Vanguard International Shares Index Fund, which tracks the MSCI World Index. So that has returned 7.55% per year before tax over the last 27 years. And of that return, about 2.9% consists of income and about 4.6% consists of capital growth. So if we deduct the income tax from these figures for someone like for like in the top tax bracket, then the after-tax investment return comes down to 6.1%. And furthermore, if we were to deduct the income tax and the capital gains tax, even though it's unrealized and you can choose when to do it, but let's just say it gets realized every year, hypothetically, then the after-tax investment return comes down to roughly just over 5% per annum. So that 5% on an after-tax basis is still higher than 3.45% on an after-tax basis. Now, this is a very mathematical approach to it, purely looking at the numbers, expected, anticipated investment returns, and just the dollar figures. This doesn't really take this too literally. It doesn't take into perspective the broader situation of someone's circumstances. So it really might not be wise for someone to go and invest rather than if they've got a huge amount of debt. It really depends overall where your situation sits and how much risk you can take and the time frame of investment that you've got. So, but from a purely mathematical perspective, it stands, but it does need to consider your overall circumstance. The other thing that's important to note is that debt reduction as a strategy provides a guaranteed return, and you get that return almost immediately. Whereas investing in the share market, as many of us would know, it's not guaranteed. It comes with risk, and it requires a long-term investment horizon to realize the adequate returns. So there is certainly a value of a risk-free investment return that should not be understated. If you don't have a particularly high risk tolerance, then maybe the guaranteed return is the option for you. Another concern with paying down deductible debt is that it erodes the benefits of negative gearing. gearing. So preserving negative gearing on an investment property whilst you're still working will typically result in less income tax payable during your working life. So maximising negative gearing benefits helps to reduce the holding costs of an investment property. And what this does is it delivers really two key advantages. So firstly, it increases your internal rate of return, which Stuart has explained in a recent podcast speaking about the internal rate of return, because the property requires less out-of-pocket expenses going towards it. And then secondly, it frees up more of your cash flow. So then it allows you to invest in other opportunities such as maximising super contributions or investing elsewhere in share portfolio or the like. The problem, however, with maintaining that high negative gearing, it's fine whilst you're working. However, then once you retire, when your income significantly reduces, if not completely, if you retire completely straight away or if you have no other income, the negative gearing benefits significantly reduce too, because they're perfectly linked to your taxable income. So then straight away on an after-tax holding cost of the investment debt, it increases significantly. So there's a bit of a trade-off there at that pivot point of retirement. So a strategy that some people adopt is to accumulate a share portfolio rather than repay deductible debt throughout their working life, and then progressively sell the shares once retired, or even all at once sell the shares once retired in order to repay that debt. So look, this strategy works well in theory, but we wouldn't implement it very often for our clients. And the major concern with it is market risk, timing risk. So, for example, if you'd plan to then just, sell down your whole share portfolio or a large portion of it quite quickly and then just offset debt, the share market could crash right before you plan on selling the shares. Really, I think liquidating a large share portfolio in 1 year comes with risk, as well as capital gains tax that probably aren't ideal. So look, generally speaking, I think sort of the aim of the game is to get property to be at least cash flow neutral by retirement, rather than paying off all of the debt completely and then having the rental income being taxed at a high rate. I think really if you can just project to the point where your property gets to be cash flow neutral, it's got no holding cost towards it, then the negative gearing won't matter in retirement. It then allows you to then use all of that additional surplus cash flow to invest elsewhere. So to explore the impact of the different surplus cash flow strategies in the lead up to retirement, I have run some calculations based off a simple scenario. So let's assume someone is 50 years old and they plan on retiring in 10 years at 60. Let's assume they have an income of $300,000 per year. They have surplus cash flow of $60,000 per year, so that's about $5,000 per month, and they own an investment property worth $1 million with $1 million of debt owing against it. For simplicity, let's just assume they don't have any non-deductible debt and they don't have any other assets. Then with the property, let's assume it has a gross rental yield of 2.5% and a capital growth rate of 6% per annum. I've also factored in typical investment property expenses such as management fees, rates, insurance, maintenance, land tax, and I've also assumed a typical interest rate. But to be fair, I've also assumed some interest rate cuts. So let's assume 3 interest rate cuts over the next 4 years. It's a rough prediction, I guess, but just wanted to be fair on that front. For comparison, let's also assume that the share market experiences 6% capital growth and 2.5% dividend yield, just to match it against the property. And then with the dividend yield, we'll assume 70% franking. So over the next 10 years, some of the options available to this individual, and these are just some of the basic options. One of them is to allocate their surplus cash flow 100% to debt reduction. Second option is to do 50% debt reduction, 50% share investing. Third option is to do 100% share investing. And fourth option is to do 100% share investing, but inside super and via non-concessional super contributions. So there's no tax deduction included in that equation. So I've included a table which is in the blog. It might be easier for some people to look at the numbers in the table when it comes through, but I'll try and give you a bit of an overview of it here. So really, let's start with a net asset position. So the person that does 100% debt reduction, their net assets in future dollars in 10 years' time end up being 1.59 million. The person who did 50-50 with debt reduction and 50% shares, their net asset position ends up being 1.68 million. Person who invested 100% shares, net asset position is 1.76 million. And the person who invested 100% in super in shares, their net asset position is 1.81 million. So as you'll see, on a net asset basis, it stacks up investing over debt reduction. Another interesting metric to look at here is the total tax paid. So then the total tax paid for the individual who does 100% debt reduction is $907,000, and this is over a 10-year period. So roughly $907,000 of tax paid. Person who did 50-50, $873,000. Person who did 100% shares, $840,000, and the person who did 100% to super, $813,000. So you can see that the tax decreases throughout these options and the net asset position increases throughout these options that I'm running through. So under all the assumptions, the person's loan balance remains the same at $1 million, but then the person who does debt reduction, they've got money in the offset account, so their net loan balance is obviously much less. And then on all fronts, the person's property has risen in capital growth to about 1.79 million in all scenarios. And so again, to be fair, I've included the unrealized capital gains for the share portfolio. So because that some people might be thinking, well, that's a consideration there, that's a potential tax which might be realized. So for the person who invested 50-50, so 50% into the share portfolio, they'd have an unrealized capital gain about 110,000. And then once retired, the estimate of a CGT liability that they'd have to pay would be about $11,000. So that's really assuming they've got close to no other income, but I've also factored in a little bit of dividend income. That would go towards their assessable income. And then the person who invested 100% in shares, they'd have an unrealized capital gain of 217,000, and then they'd have an estimate CGT liability of about 25,000. So even if you factor in on an after-tax basis, even with the unrealized CGT and the potential CGT that they'd have to pay, by my numbers, the people investing still in a much better position. It's worth noting as well that the time period that I've used is just 10 years leading up to retirement. But if you were to extend that time frame further out, say to 20 years, well, the difference between these cash flow strategies of debt reduction versus investing is going to be even more so, but exponentially more so. So something to consider is if you're further away from retirement, the difference between these different strategies is going to be quite significant, and it's going to be far less effective going down the debt reduction route than it is going down the investing route. So I think what these figures illustrate, and particularly the total tax payable over 10 years figure illustrates, is that eroding the negative gearing benefits means that you're going to end up paying more tax. And the other interesting thing just to look at with these figures is that by not repaying any debt under that scenario, you've got to remember that the capital growth alone, it brings the property's loan to value ratio to roughly 56%, whereas in the beginning 10 years ago, it was 100% because it was $1 million property, $1 million debt, 100% loan to value ratio. So it brings it down with the capital growth to 56% LVR, and that brings the cash flow of the property. It's still negative cash flow if you don't pay down any of the debt, but it brings it to a negative cash flow of 35,000. So that's really the holding cost of the property for the person who didn't pay down any debt. And I guess the consideration there is that because they instead invested in shares, my projected dividend income plus franking credits from the share portfolio is about 27,000. So they've got a holding cost of 35,000 for the property, but then they've got income from the share portfolio of 27,000. So really, it's not ideal there. That I think they're still at an income loss overall. But I guess this gets back to my point earlier where I just think that in a good financial plan, it's about getting the property to a position where it washes its own face. So to speak, it gets to cash flow neutral. If you can get your property, which property is mostly there for capital growth, I believe, gets it to the point where it's got no holding costs and it washes its own face, and then with all the surplus cash flow you can invest elsewhere, I think that the takeaway from these numbers is that's going to be the best outcome. So really projecting that the cash flow of your investment property, there's a lot of assumptions that go into it, but as best as you can for any investor, I think it's really important to project where your property is going to get to in terms of the loan to value ratio, the capital growth, but then importantly, the cash flow position, because I don't really think that you should be allocating any more to it. If debt gets paid off, great, that's excellent. And if something's cash flow positive, great. But if it's in lieu of instead investing surplus cash flow in other assets, then I think there's particularly a trade-off there. And look, the final point I'll make is that putting yourself in a position where you retire with assets that are diversified across multiple asset classes and also puts you in a position where you've got greater liquidity buffers through liquid assets, I think that that's going to put you in good stead for retirement as well. Okay, so I'm going to jump into some listener questions now. So the first question is from Tom. Tom writes, "Love the podcast. I've been listening for 18 months and my financial literacy has definitely improved as a result." That's awesome, Tom. That's what we hope. He writes, "We are a couple in our late 30s. We currently own our home in Newcastle with an approximate value of 1.3 million and outstanding loan of roughly 700,000. We also own an investment unit that we used to live in up until 2021, which was purchased off the plan in 2018 for 570,000. It's now worth approximately 800,000 with a mortgage of 400,000 against it. Question is, would it be worthwhile considering selling the unit in the next few years whilst it's capital gains exempt, using the proceeds to pay down down our home loan and then look at reinvesting in another property or properties using the equity in our home, which would be more investment grade long term. So the first thing here, Tom, is what I'll just start by saying is I think that what you're talking about in terms of the capital gains exempt, I get the feeling you might be referring to the 6-year rule because of these time periods that you're talking about, because you originally purchased the property off the plan in 2018. So the 6-year exemption rule, that only works if you buy a home, live in it, move out and rent. But where it sounds like what you've done here is you bought that first home, the unit, then you bought a new home and then moved into that new home, and then that became your new main residence. So under that circumstance, you don't get the 6-year exemption rule. You've then indicated or nominated your new main residence as your new home in Newcastle that you've moved into. So the 6-year exemption doesn't really work, but how it does work you still get the capital gains exemption for the period of time for which it was your main residence. And so it's based off the market value of the property when you moved out of it. So that's your cost base when you moved out of it. And very specifically, if you want to get exact with it, it's when it's first available for rent. So that's really what you take as your cost base. And then your capital gains from that point onwards is what you'll pay capital gains tax on. So I don't really think that there's a huge urgency. There's not that sort of 6-year time frame that you're working within. So I think you don't need to worry about that as much. You'll always get that period of time for which it was your main residence exempt. And then look, what I'd say, whether you should keep it or not, well, I think it just really depends on whether you think it's a good investment. If it's a good investment, then why sell it? If it's got good potential or if it's performed well and you think it's going to continue to perform fairly well and you can hold it, the holding cost isn't massive, financially you can hold on to it, then I'd argue why sell it? I think keep it there. You've got some equity in it. You could utilize the equity potentially with future property purchases or anything else. So I think it really then just comes down to, is it a good investment or not? If it is, then I think hold on to it. Okay, the next question is from Simon. Simon has a question about internally geared ETFs. So he says, I've been exploring investment options and came across leveraged ETFs. While they seem to offer potential for high returns, I'm also aware that there's significant risk involved. Could you please elaborate on the main pros and cons of investing in leveraged ETFs? Specifically, how do they compare to traditional ETFs in terms of risk, return, and suitability for long-term investment strategies? So Simon, the first thing I'll just say, just to explain the gearing arrangement within these internally geared ETFs is, so the gearing, just so you're aware, it's a little bit like a limited recourse borrowing arrangement from the perspective that you'd never be required to pay back any of the debt. It's all handled with internally. There's not exactly a margin call with these products from the sense that you'd never be required to pitch in money. They'd never come back to investors and say, hey, the margin's gone below a certain level. We need you to pitch in again and contribute further funds. There'd never be a margin call in that sense, but there is effectively like a margin call effect within the product itself. So it's got to stay within those gearing ranges of 45 to 60%. With one particular product, they vary, but it's got to stay within their gearing ranges. So, if there's a drop in the share market by 30% and it pushes that gearing range on the upside of that 60%, they don't have to sell down to get it within that target range. And it's not a great outcome. That's not a good scenario there because you're selling down often at a low point in the market, a little bit like you would in a traditional margin call. So that's something that I don't like about them, is that they need to stick within those gearing ranges, and it can sort of force sales of assets internally within the product at a time when you arguably don't want to be. And the other thing just to be aware of, which I think is a real positive, is that the leveraging inside the ETF, it doesn't go towards your borrowing capacity at all. So for people that might be completely tapped out or maxed out in terms of their borrowing capacity, but they do want to access some more leveraging in their share investing, it's a good way of doing it. You don't have to go through any sort of finance assessment or approval. You can just, you just buy the ETF and it's internally leveraged, and you don't have to declare that if you then went to get a loan outside of your share portfolio or any other sort of property loan. So it doesn't go towards your borrowing capacity. So I think that that's a good benefit in that it allows gearing to people. So really, how does it work in terms of the outcomes? Well, it just exaggerates. So if you look at it from a performance perspective, it exaggerates the outcomes is the best way that I'll explain it. So what that means is if the share market goes up, a geared ETF goes up more, a lot, like usually twice the amount. It looks like roughly twice the amount. But if the share market draws down or goes down, it will go down twice the amount. So good examples here I think you should go and have a look at, Simon. So VanEck have something, the ticker code is MVW. It's an Australian equal weight index ETF. And so it's equal weight of ASX 200. Not exactly, it's got 72 holdings because there's some liquidity and size elements in it, but it's kind of roughly speaking, it's an equal weight index for Australia. So if you jump on their website and have a look at MVW, they've then got the exact same investment option but a geared version of it. So the ticker code is GMVW. So if you have a look at those returns, and GMVW, the geared option's only been around for about 6 months or so. So it doesn't have a very long investment time frame. The non-geared option does, so you can go and have a look at that. But just for interest's sake, just as an example of the effect of the performance returns, if we look at just the last 6 months. So the non-geared option in the last 6 months, the equal weight Australian returned 9.99%, whereas the geared option returned 19%. So it's basically double. And if you look at the last 3 months, the ungeared option returned 6.3%, whereas the geared option returned 12.3%. So again, it's pretty much double. So that looks great in periods when the share market in the last 3 and 6 months has done well, but the exact opposite would happen. You'd have a much larger drawdown, probably double the drawdown on the way down. So that's the risk there. Another good one, Simon, to have a look at is by Beta Shares. So it's the Geared US Equity Fund. So the ticker code is GGUS. If you jump on their website, it's a really good graph there, which you can have a look at, which kind of visualizes or illustrates this drawdown exercise. So in periods where there's been large drawdowns, so in 2018, 2022, periods where there's large market drawdowns, you'll see that the S&P 500, so this particular ETF tracks, it's basically the S&P 500, it's the market cap weighted, it's not equal weighted, but this is just a geared and hedged version of it. If you have a look at the graph on their website there, if you see there's a small drawdown for the S&P 500, then there's a very large drawdown for this geared option. If you also go through, that'll have on a table there the performance returns. So looking at the last 12 months, the S&P 500 has returned 33%. This fund, the Gear Fund, has returned 69%. So it's, again, basically doubles. I should have mentioned earlier, sorry, both of these ones that I looked at, the VanEck Australian one and then this one, Beta Shares S&P 500, they're both about 50% geared. They sit around 50% geared. There's a range. I think they're sort of range from about 45 to maybe 60% leveraging percentage, but they both sit at around 50% gearing at the moment. And then that explains the performance. So encourage you to have a look at that. It's quite interesting. I look at this every now and then, but I had to look back at them. I mean, if you look at longer term over the last 5 years, the average return kind of smooths out a little bit in some ways. So the S&P 500 has provided a compounding annual growth rate, performance rate of 15% over the last 5 years, whereas the geared one by Beta Shares has done about 20%. So that's probably a bit truer in that it shows there's been some large drawdown periods over the last 5 years. But really, I think theoretically, if you think that the share market goes up more than it goes down, then I think a gearing option can be a good one. So something to look at. From a fees perspective, Simon, basically you pay for the leveraging. You do. Roughly speaking, you're going to pay about double the fees is kind of how it works. It does with that VanEck equal weighting one, and it does with this US equity geared one as well. So it's roughly speaking about twice the fees. So look, Simon, I think you've got to be just aware and careful if going into the geared ETFs. They can offer some great benefits, but then the drawdowns can be much larger as well. They've got higher volatility. Something else I'd say as well is, I mean, as much as, it's very hard to time the market, I'd be less inclined to invest in a geared S&P 500 market cap weighted index at the moment. That's just really, those figures that I mentioned before in the last 12 months, that's gone gangbusters. So I'd be pretty nervy about doing that. And if I had to pick between the two options that I've just mentioned, and there's a lot out there, and I'm not recommending either of these options, but I was picking between the two that I've just spoken about, I'd probably be more inclined to go the equal weight Aussie option there. So look, just be aware of the risks involved, and I hope that gives you a little bit more of an understanding. The next question now is from Adam. So Adam starts by giving a summary of his situation. So he says, we're a couple, we're 38 years old, combined income of 150,000 because my wife took some time off to look after the kids. I've got a home worth 1.2 mil and then a loan worth 350,000 with 100,000 in the offset account. So therefore net debt of 250,000. I've got two investment properties. One's worth 550 with 220 debt against it. One's worth 570 with 330,000 debt against it. And then they've got combined super balances of 225,000. His question is, look, we'll be receiving $400,000 from the sale of shares in the business. So about 250,000 now and 150,000 in 3 to 5 years' time. What should we do with the proceeds? Should we pay off the home loan, invest in shares, add to super? And there's a second question, which I'll come to in a moment. moment. But to answer that one first, look, my first question is there going to be CGT from the sale of those shares? So I haven't sort of mentioned that there, but if there was, I would certainly look at to find out whether you have any carry forward concessional contributions. So that's unused concessional contributions over the last 5 years. So if you haven't maxed out your concessional contribution caps over the last 5 years, you would have some unused cap there. You can use those given that your individual super balances are both under 500,000 because your combined super is 220. So I think you'd want to firstly look at, is there any capital gains tax that needs to be cleared? If there is, I'd consider using those. They're a great way of clearing it. You basically put money into super and it can clear a lot of the capital gains depending on how much the capital gains tax is. Look, if there's not, or even if there is, but also as a side note, would we pay down the home loan? Look, there's only $250,000 owing against the home, Adam, and you're 38 years old. I mean, you've got that in pretty good stead. I think you're doing well there. Look, I think by the time you plan to retire, I think the home loan's going to get paid off. So I think you probably don't need to focus too much attention on that. I think it'll naturally sort itself out, I think, by the time you retire. I'd also probably say that the investment properties, look, I haven't run the numbers on this exactly, but I think that they get to roughly cash flow neutral over the next 10, 15, certainly 20 years. And as I spoke about a little bit earlier in the podcast, I think really that's the aim of the game. I don't think, there's no point paying them off quickly so then you're just paying tax on the rental income whilst you're working. So I don't think I'd probably have them on interest only and I'd be leaving that debt where it is, the investment property debt, the deductible debt. So then I really think that leads me to say that I'd probably invest it. So I think it's a bit of a balance between, do you want access, because you're only 38, so if you put it all in super, that's going to be the best net asset position result as per my, the scenario that I ran earlier, but you're going to lose access to it. And I don't think that I would if I was in your position, but I think that I would. So you want access to it? I think that I'd invest it. So I'd sort out any capital gains tax that's coming from the sale of the shares, and then I'd get started with, making a start with a share portfolio with 250,000. That's a great way just to kickstart it and have the money there. And I think that that's what I'd do in that circumstance. I'd get investing because it sounds like, aside from super, you don't have any other liquid assets or investments. It's all property. You've got 2 investment properties outside of super. So I think it's a good time to diversify and do that with it. The next question from Adam, again, but I've sort of broken it down into 2 questions. He then goes on to ask, we're looking at starting an SMSF to invest in residential property in the next few years, likely Melbourne. You don't hear a lot of people investing in residential properties in SMSFs. In my current situation, would you consider that an option? That's right, Adam. Look, I commented on a previous podcast that, it's gone out of vogue. You don't see it as much, really, investing in property inside super. It was really going gangbusters about 10 years ago, but changed for various reasons. So it doesn't happen as much now, but we do still see it a little bit. Would I do it if I was you? Well, with a super balance of 225,000, I don't think that I would. I don't think it's right. That's still a little bit too low, that balance, to, I think, warrant the feasibility of setting up a self-managed super fund. And if you think about it, if you were to go and buy a property and the best LVR you can get is about 70% LVR. So with your 220,000, factoring in some costs and other expenses and liquidity buffers, really you could only probably afford a property worth 700,000. And I just think, you've got 3 properties already, your home and 2 investment properties outside super. To go and buy another 700,000, it's in a similar price point to what you've already got. And I'd question whether in Melbourne you're going to get great quality for 700,000. That's going to be, I question the quality of the actual asset if you're buying for 700,000. So, these things are leaning to me towards saying no. You'd also be putting all your eggs in one basket, all of your super fund in one property. You might run into a little liquidity issue, maybe, but you're only 38. So I think you've got a lot of time to start, building up the liquid assets inside of super. So you may not be running into a liquidity issue, a liquidity trap with having it all in property because you've still got many years of working and contributing to super. And then I think just more broadly looking at your overall situation, you've already got 3 properties. And I think for all those various reasons, I probably wouldn't do it, Adam. I think I'd stick with what you've got, make sure your super fund's invested well. Yes, and I wouldn't do it anytime soon. Okay, Adam, I hope that helps. And I've probably got time for one more listener question now. So the last one is from Rob. Rob writes, I'm 56 and my wife is 55 and we intend to retire when my wife turns 60 and we can both access super. So in about 5 years' time. Here's a breakdown of our current situation. So we've got 800,000 each in super, 1.6 mil total. Mortgage-free family home in regional New South Wales worth 1.75 mil. Investment property in and north of Melbourne worth 1.75 mil. It's got an $800,000 mortgage, but it's 100% offset with 800,000 of cash. They've also then got an emergency cash holding. Current incomes are about 180,000 each. The investment property provides them with $44,000 of rental income. Current situation or strategy is for them both their salary sacrificing into super up to the concessional $30,000 limit, with all the surplus after-tax cash flow equally going into each other's super accounts. So I'm guessing with non-concessional contributions on top of that, with any surplus cash flow. We're holding the $800,000 cash in the offset account, fully liquid for a rainy day to take advantage of any unforeseen opportunities and to help our young adult children possibly buying a house. Our question is, could we be doing more with our money? We don't know what we don't know, and we're mindful that we might be missing some better strategies. So Rob, look, well done. I think you're in a great position there. It's looking really good. I'll just say, firstly, I like that you're salary sacrificing up to the concessional contribution cap. That's great. You should be doing that. I like that you're also topping up super with any additional surplus cash flow at the end of the year into super equally. Another thing that I like in your situation, I like the large high value of your properties. So sometimes we're seeing a lot with people that've got sort of lower value properties and a lot of them. I'd always personally go quality over quantity. So it sounds like, 1.7 mil property in Melbourne. I don't know where it is. I don't know the address. I don't know the quality of the investment, but looking just purely at the value, I think, if you're going to do property, you got to do it right. And unfortunately, it's an unfair game whereby the higher value properties, I think, tend to be the higher quality. So yeah, quality over quantity, I think that's good. You've gone hard on one property and I hope that it's a good one for you. In terms of helping out the kids, in terms of these unforeseen opportunities and having a rainy day fund and the cash buffer. So look, I just need to ask more questions about, so when do you plan to help them out? How much do you want to help them out with? And then the key question is, can it wait until 60, in sort of 5 years time? So if it can, that help can come from super, because you'll be able to access super then. When you retire, you'll have full ability to access it. So if it can, then I'd argue you're much better using super, really trying to maximize it up to the 1.9 mil transfer balance cap, which is the total amount that you can have in pension phase. You can have more in super anyway, and it only gets taxed at 15%. But yeah, I'd be really trying to maximize that to get it invested in a tax-free environment, if that means you can hold off till then. But really, I don't know your circumstance and how much of a rainy day and emergency fund you need, but you've got 800,000 sitting in cash in the offset account, plus an emergency fund, which I don't know how much that is, but that's a lot. That's a lot to have in cash there. I don't know what you think's going to happen exactly, but me personally, I think that that's quite a lot to have just as an emergency buffer amount. I'd personally go and invest some of that. So probably in super, because it's going to be more tax effective. You could probably pull 300,000 out of that 800,000 in the investment property offset account. And I'm guessing, maybe I haven't done the numbers, it might get it to about cash flow neutral. If you think about it, the 44,000 of rental income that you're receiving at the moment, because you don't have any loan interest on it, you're getting taxed at, I think you're probably in the tax bracket getting taxed at 39%. So that 44,000 on an after-tax basis, it's about 26,800. So it's not really very tax effective. I'd argue that if you pulled some money out, got the property to cash flow neutral, invested it in some liquid assets, and then you could maybe move that back after retirement when there's better tax implications because you'd have the tax-free threshold once you stop working. I'd argue that might be a little bit better, but it comes down to what you're comfortable with. I think on a pure numbers basis, mathematically, I'd probably show you that it would work out better on a mathematical basis to go and invest some of it, particularly in super. But look, your comfort levels are your comfort levels, and if you need to have $800,000 in a rainy day emergency fund plus then another amount, then that's up to you, and it really depends on when you're going to help out the kids. But yeah, I hope that gives you something to consider, Rob. So look, sorry, I've gone a little bit over time here, but that's certainly all I've got time for today. So look, thanks very much for listening. Bye for now.